Every time you type a prompt into an AI or stream a 4K video or will basically do anything online, there's this persistent illusion of weightlessness.
Right, it all just feels like magic happening in the ether.
Exactly. We use words like the cloud or wireless, but we know you tune in because you want to cut through that information overload and get to the real aha moment.
Because the terminology we use completely masks the physical reality. I mean, the digital footprint of our daily lives is expanding at a staggering rate,
Yeah.
and it is anything but weightless.
Yeah, it's incredibly heavy.
Oh, absolutely. It requires millions of tons of steel, massive liquid cooling systems, and above all, just an astronomical amount of power.
The physical footprint is staggering. And today, our mission is to look at the perfect example of this hidden reality in a stack of financial documents.
Sure.
We're diving into the Q1 2026 earnings report, the management's discussion and analysis, and the earnings call transcript for a company called Enerflex.
Ticker symbol EFXT.
Right. Now, at first glance, their profile reads like a traditional Calgary-headquartered energy infrastructure company. They specialize in natural gas compression, gas processing, refrigeration-heavy industrial applications.
Yeah, on paper, it sounds like a very conventional oil and gas services play.
Which might sound, let's be honest, a little dry to someone scanning the stock ticker. But okay, let's unpack this. Because the real story hidden in these financial filings is how this traditional energy company is secretly becoming a critical backbone for the massive global AI and data center boom.
It really is a fascinating pivot.
Yeah.
To understand how they're bridging that gap between traditional energy and big tech, you first have to understand the physical mechanisms of their three main product lines.
Okay, lay it out for us.
So first, there's energy infrastructure, or EI. These are the massive physical installations they own and operate under long-term contracts.
Like giant facilities out in the field.
Exactly. Facilities processing and compressing natural gas so it can actually move through pipelines.
Yeah.
Then there's aftermarket services, or AMS. This is their recurring revenue stream.
Got it. Because machinery needs upkeep.
Right. When you're running massive industrial engines 24/7, they require constant maintenance, parts replacement, overhauls.
The literal nuts and bolts that keep the machinery from breaking down under continuous strain.
Yeah. And finally, there's engineered systems, or ES. This is the division where they custom engineer, design, and manufacture these massive processing and electric power solutions from scratch for specific clients.
Wow.
And when you look at how these three divisions interact, it provides this really fascinating lens into global supply chains, geopolitical risk, and the insatiable global thirst for power.
Well, let's move right into the financial reality of that demand because their Q1 2026 headline numbers show some serious momentum as proof.
They definitely had a strong quarter.
Yeah, I want to share a few top-line wins. They reported $584 million in revenue, an EPS of 35 cents, which actually beat consensus by 8 cents, and an adjusted EBITDA of $137 million. Plus, they reduced their net debt to $505 million.
But the number that really jumps off the page is their return on capital employed, or ROCE. It hit a company record of 17.3%.
Why is that specific metric so important here?
Because in heavy industry, you're dealing with massive capital outlays, buying thousands of tons of steel, employing specialized engineers. ROCE measures how efficiently a company is turning all that expensive physical machinery into actual profit.
Ah, I see.
So hitting 17.3% in a capital-intensive business means they aren't just growing, they're operating with extreme efficiency.
But looking at the financials, I noticed a pretty glaring contradiction. I have to push back a little here.
Okay, what did you see?
If they're making so much money and hitting record returns on their capital, why did their free cash flow completely plummet? I mean, a year ago, their Q1 free cash flow was $85 million. This quarter, it dropped to just $15 million.
Yeah, that is a sharp drop.
Right. It's like a highly successful bakery. There's a line at the door. Everyone's buying bread. But the owner opens the cash register at the end of the day, and it's just empty. Because, as it turns out, they took all the cash and bought a year's worth of flour. Is that essentially what's happening here with Enerflex?
What's fascinating here is that this drop in free cash flow isn't a sign of weakness at all. It's a strategic calculation. Your bakery analogy is spot on, but let's look at what that flour actually is in heavy industry.
Okay.
In Enerflex's case, it's a $63 million working capital investment. They are intentionally buying up physical inventory and tying up their cash in parts and equipment, particularly across North America and Latin America.
So they're tying up $63 million on purpose.
Yes, because in Latin America, They have massive scheduled maintenance coming up on those energy infrastructure assets we talked about earlier. You can't perform an overhaul on a giant gas compressor if you're waiting on a critical valve to ship.
Right, that would stall everything.
Exactly. And in North America, they're building inventory to support the incredible demand they're seeing in their engineered systems business. They're using their cash now so they don't get caught empty-handed, stalling multi-million-dollar projects when the orders actually come due.
Well, the mention of future growth and this North American demand is the perfect pivot to our next question. We keep talking about natural gas, but the tech sector is quietly pulling the strings here. Where exactly is all this new demand coming from?
That shift is most evident in the engineered systems division.
Oh man, the numbers for that ES division are wild. In Q1 alone, they secured $483 million in bookings.
It's a massive jump.
Right. Their book-to-bill ratio is sitting at 1.5x. And just so we're all on the same page, a 1.0 ratio means you're receiving $1 in new orders for every dollar you bill out.
Right, so a 1.5x ratio means they're literally booking orders 50% faster than they can fulfill them.
The backlog is swelling. But here's where it gets really interesting. In the earnings call, CEO Paul Mahoney specifically highlighted a newly awarded project that kind of explains the surge.
Yeah, it wasn't a traditional oil and gas refinery project.
No, it was a behind-the-meter power generation project specifically for a data center.
Utilizing reciprocating engine generator sets.
When I read that, it felt like the veil was pulled back on the AI boom. Tech companies need power to run these server farms, and they need it immediately. But wait, break down the mechanics here for us. Why reciprocating engines running on natural gas? Why not just plug the data center into the local grid or build a solar farm?
Well, it really comes down to the physical requirements of data centers. Servers cannot handle voltage drops or intermittency. If a cloud passes over a solar farm or the wind stops blowing, a data center can't just power down for an hour.
That makes sense. They'd lose everything.
Exactly. They require steady, continuous, heavy baseload power. Reciprocating engines are essentially massive, highly efficient versions of the engine in your car, but instead of gasoline, they run on continuous streams of natural gas to send generators.
Providing incredibly reliable 24/7 power.
Yes, and their visibility into these specific power generation opportunities has absolutely skyrocketed.
Yeah, Enerflex noted their potential pipeline went from 1.5 gigawatts to over 5 gigawatts. Wait, 5 gigawatts?
That's a huge leap.
Let's put that in perspective. 1 gigawatt is roughly the power consumption of a mid-sized city. They're looking at enough power generation to run multiple cities, solely driven by data centers and heavy industry.
It's almost hard to wrap your head around.
It is. How do they even begin to deliver that? And why bypass the public grid entirely?
The tech companies are bypassing the grid primarily because of time. As AI scales, the traditional public electrical grids simply cannot keep up with the sheer volume of electricity required.
They just move too slowly.
Exactly. Permitting and building new major transmission lines or traditional utility-scale power plants can take a decade. Tech companies moving at the speed of artificial intelligence cannot wait 10 years for the local utility to lay new cables.
So they just build their own.
That is the definition of behind the meter. The tech companies are essentially building private power plants on site, right next to the data centers. They go straight to a company like Enerflex, who can engineer, build, and maintain these natural gas power generator sets.
Creating island power.
Exactly. Direct, reliable, independent electricity that isn't reliant on the strained, slow-moving public grid.
Which perfectly solves the tech company's problem, but it creates a massive logistical hurdle for Enerflex. I mean, if you have a 1.5x book-to-bill ratio and 5 gigawatts of potential opportunities knocking at your door, how do you actually get the physical parts to build these giant engines?
Right, because the global supply chain is notoriously constrained.
Exactly. There's a detail in the Q&A portion of the earnings call that highlights this. Enerflex's purchase obligations stepped up by about $230 million this quarter. The CFO mentioned they're securing long lead equipment all the way into 2027 and even 2028.
Yes, that was a key moment in the call.
I have to challenge this strategy, though. Isn't pre-ordering massive industrial parts for 2028 incredibly risky? It feels like buying really expensive concert tickets for a band 4 years from now, hoping they don't break up before the show. What if the AI boom cools off?
If we connect this to the bigger picture of how industrial procurement actually works, the risk profile is quite different. The CFO clarified that this $230 million increase in obligations does not mean $230 million of cash just left their bank account.
Wait, really? Oh, so they aren't paying full price up front.
Not at all. Your concert ticket analogy is good, but let's look at the mechanism. Enerflex is essentially securing their spot in line at the original equipment manufacturer, or OEM factories.
Okay, how does that work?
Large industrial engine blocks aren't just stamped out on an assembly line. They require massive foundries to pour molten steel, and there are only a handful of foundries on Earth capable of doing this at scale. Enerflex is paying a fraction up front to reserve foundry time 2 years from now.
Ah, I see.
Because Enerflex is a $2.6 billion enterprise that procures over $1.6 billion in supply chain materials globally, they have the leverage to negotiate these forward positions.
So the concert ticket is basically just a reservation fee to ensure they actually get to go to the show.
It's strategic capacity management. They're ensuring that when 2027 rolls around, their growth isn't choked off because a competitor booked all the foundry time.
That makes a lot more sense.
And this ties directly into another major initiative they discussed. CEO Paul Mahoney's enterprise-wide productivity system. As they manage this immense $1.3 billion backlog in engineered systems, they're leaning heavily into continuous improvement.
But in a company this size, spanning multiple continents, what does a productivity system actually look like on the ground?
Well, it means breaking down regional silos. Instead of the North American team and the Middle Eastern team sourcing parts independently, they integrate the supply chain globally to leverage their sheer scale for better pricing.
Oh, that's smart.
It also involves modernizing their IT and automation systems. By using cleansed, uniform data, they can squeeze out better margins and execute faster. When you have a $1.3 billion backlog, even a 1 or 2% improvement in execution efficiency drops millions of dollars straight to the bottom line.
Tightening the ship while you're sailing fast. But, while the North American tech boom and this data center narrative are really exciting, Enerflex is fundamentally a global player.
Absolutely.
Operating heavy infrastructure internationally brings us to a very different kind of reality. We have to talk about the geopolitical tightropes and the very human risks involved here.
Operating physical machinery across multiple continents carries layers of friction and risk that purely software-based companies simply do not face.
Let's look at their broader global maneuvers first. They are actively streamlining, right? They announced they're divesting the majority of their Asia-Pacific operations, which covers Australia, Indonesia, and Thailand, to ANEO Group to focus on core markets.
Right, while maintaining a massive footprint elsewhere.
Yeah. Meanwhile, in the Middle East, the documents outline 17 distinct projects across Bahrain and Oman, representing an installed fleet of 350,000 horsepower.
That horsepower metric is crucial to understand.
Yeah. Why do they need 350,000 horsepower of compression in the Middle East?
Extracting natural gas from deep underground in extreme desert environments requires massive physical force. You need giant compressors to pressurize the gas so it can physically move through processing facilities and hundreds of miles of pipelines.
And that pressure requires immense horsepower.
Exactly.
Now, management specifically addressed the geopolitical situation in the region during the call. And we should be clear here to you listening that we are just impartially reporting on how the business is navigating this without taking any political stance on the conflict itself. Management stated that they are closely monitoring the situation, but to date, their operations in the Middle East have remained uninterrupted. Their local teams are using established response processes to ensure the safety of personnel. Management even noted that whenever the conflict eventually finds a resolution, there will likely be a need for reconstruction and debottlenecking, which they are positioned to provide.
It really highlights the complex reality of their business.
Yeah.
They provide critical infrastructure that must keep running, but they also have to protect their people on the ground.
Right.
And unfortunately, that risk isn't just theoretical. There is a very sobering detail buried in the legal proceedings section of the MD&A that illustrates exactly what happens when those physical risks become reality.
Yeah, it involves an ongoing arbitration over an international engineered systems project. The documents state that in the second quarter of 2024, there was a fatal attack at an adjacent site to where Enerflex was working.
It's just a tragic situation.
In response to that tragedy, Enerflex declared force majeure, suspended activity at their project site, and demobilized their personnel to ensure their safety.
For context, force majeure is a standard legal clause in these massive contracts that essentially means an unforeseeable, unavoidable event, like a natural disaster or, in this case, a severe security threat. that prevents a party from fulfilling its
Which
obligations.
seems like the only responsible thing to do when lives are at risk, but the customer didn't see it that way.
No, the customer sent a notice purporting to terminate the contract and actually commenced arbitration proceedings against Enerflex, alleging a breach of contract.
Wow. So Enerflex subsequently delivered its own notice terminating the project and filed a counterclaim to recover the amounts they believe they're owed.
Yes, and the financial stakes attached to this are massive.
The documents note that the carrying value of the remaining assets associated with this project is $161 million. Just to clarify, carrying value means that's what the stranded equipment is currently worth on Enerflex's accounting books. Plus, Enerflex has a $31 million letter of credit hanging in the balance. How does a letter of credit work in a dispute like this?
In international projects, the customer often requires a letter of credit from the builder's bank to guarantee performance. It's essentially $31 million sitting with a neutral financial institution.
Oh, okay.
The customer is trying to draw upon those funds, claiming Enerflex failed to perform, while Enerflex maintains that drawing the funds would be improper because the stoppage was a legally justified force majeure response to a fatal security threat.
This raises an important question, and it's one that every global infrastructure company has to grapple with. How do you balance your fiduciary duty to your shareholders and your global expansion goals with the absolute paramount need to ensure the physical safety of your personnel in volatile regions?
It is the ultimate friction of the physical world. A tech company can deploy a new software update globally in a fraction of a second, with zero physical risk to their employees.
Right.
But building a 5-gigawatt power infrastructure globally requires navigating ocean freighters, constrained steel foundries, international borders, local politics, and physical safety protocols.
So, what does this all mean for you listening right now? If you really want to understand where the future of the AI boom is heading, you can't just keep your eyes glued to the software companies writing the code.
No, you have to look at the nuts and bolts infrastructure companies.
Exactly. Companies like Enerflex. Because without the physical machinery, without the natural gas compressors moving fuel across deserts, without the behind-the-meter generators powering the server farms, the cloud simply goes dark.
The physical world is still very much in charge of the digital one. And that leads to a fascinating thought to take away from all this. We're watching the world's largest tech giants increasingly rely on behind-the-meter power generation. They're doing this to intentionally bypass strained, slow-moving public power grids.
Right, creating those island power setups.
Exactly. So if this trend continues to accelerate, will industrial companies like Enerflex eventually evolve into the new private shadow utilities of the 21st century?
Wow.
If the public grid cannot handle the sheer velocity of the future, these private networks might just become the most critical infrastructure on the planet.
Shadow utilities. Now that is something to think about the next time you ask an AI a question and get an answer in 2 seconds flat. Thank you for joining us on this deep dive. We know your time is valuable, so keep questioning the narrative, keep looking for the physical realities behind the digital hype, and we will catch you next time.